you put $100 in a savings account earning 2% interest per year, how much would you have after 5 years if you leave the money there? More than $102? Exactly $102? Or less than $102? Pause the video for a second and actually think about it. Because this one tiny question reveals something shocking about how people manage money. The correct answer is more than $102. Not because the bank suddenly became generous, but because of something called compound interest. Your money earns interest, and then that interest starts earning interest too. Simple concept, but here's where things get uncomfortable. Studies from the Organization for Economic Cooperation and Development and the World Bank show that most young adults cannot correctly answer basic financial questions about interest, inflation, and diversification. And yet, when surveyed, many rate their financial knowledge very high. That gap between confidence and reality is called the knowledge perception gap. In fact, research shows only around 14% of young adults can correctly answer basic financial literacy questions. Think about that. That means 86% of young adults are making financial decisions without fully understanding the rules of the game. And here's the real problem. Your 20s are not just another decade. They are the most powerful financial decade of your life. Because time is the one asset you can never buy back. Every year you delay investing, saving, or learning about money, the cost isn't just dollars, it's compounding opportunity. And the modern economy makes these mistakes even more dangerous. Inflation quietly eats your purchasing power. High-interest debt compounds against you. Digital investing platforms make trading feel like a video game. And scams targeting young investors are exploding. According to financial crime reports, over $63 billion is lost each year to non-credit card fraud, much of it targeting younger, tech-savvy investors. So today, we're breaking down the silent wealth killers, the biggest financial mistakes people make in their 20s. Not the obvious ones everyone talks about, but the subtle traps that quietly destroy long-term wealth. Because if you can avoid just a few of these mistakes early on, you unlock what I like to call the greatest financial cheat code in the world: time. And by the end of this video, you'll know exactly how to turn your 20s into a financial launchpad instead of a financial regret. So let's start with the first silent wealth killer, the mistake almost everyone makes, even people who think they're good with money.
The first silent wealth killer in your 20s isn't credit cards. It isn't inflation. It's something much more subtle: overconfidence. Now, this might sound strange. Most people in their 20s don't feel rich, powerful, or financially secure. In fact, many feel the opposite. But here's the paradox. When researchers ask young adults about their financial knowledge, a large percentage rate themselves as above average. But when those same people are asked basic financial questions, the type we opened this video with, the results tell a very different story. Studies referenced by organizations like the Organization for Economic Cooperation and Development show that financial literacy among young adults is surprisingly low despite high self-confidence. This is what experts call the knowledge perception gap. In simple terms, people believe they understand money, but they don't actually understand how money works. And that gap can become incredibly expensive. Because when you think you understand something, you stop learning. You stop asking questions. You start making bigger financial decisions based on incomplete information. And the modern financial world makes this even worse. Today, anyone can open an investing app in under 5 minutes. You can buy stocks, trade options, invest in crypto, and even use leverage, all from your phone while sitting on the couch. It feels empowering, but it also creates the illusion that access equals knowledge. Just because investing is easy to access doesn't mean it's easy to understand. In fact, behavioral finance studies consistently show that overconfident investors trade more often and earn lower returns. Why?
because they underestimate risk and overestimate their ability to predict the market. In your 20s, this often shows up in subtle ways: following stock tips from TikTok, chasing the latest crypto trend, believing you can beat the market quickly, ignoring long-term investing in favor of short-term wins. And every time you do that, you're stepping further away from the one advantage you actually have: time. Remember, wealth is rarely built through clever trades. It's built through consistent decisions repeated over decades. The smartest investors in the world aren't the ones who know everything. They're the ones who never stop learning. They respect risk. They understand what they don't know. And most importantly, they stay humble in front of the market. Because the moment you believe you've figured out money, that's usually the moment it starts costing you the most. Which leads us to the second silent wealth killer, a concept so simple yet so misunderstood that it quietly drains wealth from millions of people every single year. If there are three financial concepts that determine whether someone builds wealth or struggles with money their entire life, it's these: compounding, inflation, and diversification. Economists often call them the big three. And here's the scary part: a huge percentage of young adults don't fully understand any of them. Research highlighted by institutions like the World Bank and the International Monetary Fund consistently shows that financial literacy around these core ideas remains surprisingly low worldwide. Let's break them down quickly. First, compounding. Compounding is the engine behind wealth. It's the reason a small investment can grow into something massive over time. If you invest $200 per month starting at age 22, earning an average return of 7% per year, by age 60, you could end up with hundreds of thousands of dollars. But if you wait just 10 years and start at 32 instead, you might have to invest twice as much every month to reach the same result. Not because investing got harder, but because time disappeared. That's compounding. The earlier you start, the more the math works in your favor. Now let's talk about the second concept: inflation. Inflation is the silent thief of purchasing power. It's why $100 today doesn't buy what it used to buy 10 years ago. And here's something interesting about young people. Many in their 20s today grew up during long periods of low inflation, so it's easy to underestimate how powerful inflation really is. But recent economic shifts showed how quickly prices can climb. Groceries, rent, energy, transportation, suddenly everything costs more. And if your money is just sitting in a low-interest savings account, inflation is quietly shrinking its value every single year. Finally, we have diversification. This is one of the most important principles in investing. Instead of betting everything on one stock, one asset, or one trend, you spread your investments across many different areas: stocks, bonds, global markets, index funds. Why? Because nobody, not even professional investors, can consistently predict which asset will perform best. Diversification protects you from being completely wrong. And trust me, every investor is wrong sometimes. The problem is that when people don't understand these three concepts, they start making decisions based on emotion instead of strategy. They hold too much cash, they chase trends, they bet everything on one idea. And that's when the real damage begins. Because ignoring these basics leads directly into the third wealth killer, a mistake that costs people hundreds of thousands of dollars over their lifetime. And the worst part? Most people don't even realize they're making it. Here's one of the biggest financial lies people in their 20s believe: I'll start investing later. Later when the salary is higher. Later when life feels more stable. Later when there's more money left over. But in the world of personal finance, later is incredibly expensive because the most powerful force in investing isn't skill, it's time. Let me show you why. Imagine two people. Alex starts investing at age 22. Jamie starts investing at age 32. Alex invests $200 per month for 10 years and then stops completely at age 32. Jamie waits until 32 but invests $200 per month every year until age 60. So Jamie invests for 28 years, while Alex only invests for 10 years. Now, here's the shocking result. Because of compounding, Alex can still end up with more money than Jamie by retirement. Why? Because Alex gave their investments an extra decade to grow. This is the magic of compound interest. Small contributions made early become massive over time because your returns start generating their own returns. Financial educators and investor resources like the U.S. Securities and Exchange Commission constantly emphasize this idea. Starting early matters more than investing large amounts later. Your 20s are essentially a financial cheat code. You have decades ahead of you. Decades where compound growth can quietly build wealth in the background while you live your life. But many people miss this opportunity because they believe investing requires huge amounts of money. It doesn't. Consistency matters far more than size. $50 a week, $100 a month, automatic contributions to an investment account. These small habits repeated over years can become life-changing. But when people delay investing, they unknowingly force themselves into a much harder financial future. They'll have to invest larger amounts, take more risk, or work longer just to reach the same destination. And unfortunately, waiting rarely happens alone. It's usually accompanied by another dangerous mistake, a mistake that millions of people discover only after it's too late. The next silent wealth killer, financial fragility, and it's far more common than most people realize. Imagine your car suddenly breaks down. The repair bill is $400, not $4,000, not $40,000, just $400. Now here's the uncomfortable question. Could you pay that today without going into debt? Because for a surprising number of people, the answer is no. Economic surveys from the Federal Reserve System have repeatedly shown that a large percentage of adults struggle to cover a $400 emergency expense with cash. Even more concerning, researchers often use another number as a warning sign of serious financial instability. If someone cannot raise $2,000 within a month, it's considered a major indicator of financial fragility. And this is one of the most common money mistakes people make in their 20s, not building an emergency fund. Here's why this matters so much. Life is unpredictable. Cars break down, medical bills appear, jobs change, apartments require deposits, flights home for family emergencies happen. None of these events are unusual. They're just part of life. But if you don't have an emergency fund, every unexpected expense forces you into the same trap: debt. You swipe a credit card, you take a personal loan, you borrow money and promise yourself you'll figure it out later. But later comes with interest, and not interest compounds against you. Instead of your money growing quietly in the background, your debt starts growing instead. What could have been a small inconvenience becomes a financial setback that takes months or even years to recover from. Think of an emergency fund as financial armor. It doesn't make you richer overnight. It doesn't produce flashy investment returns, but it protects you from the kinds of mistakes that destroy wealth before it even begins. Most financial planners recommend keeping 3 to 6 months of essential expenses saved in a high-yield savings account. That may sound intimidating at first, but remember, it doesn't have to happen overnight. Start with a simple milestone, $500, then $1,000, and then build from there. Because once you have a financial cushion, something powerful happens. You stop making decisions out of panic, you stop relying on expensive debt, and you gain something incredibly valuable in your 20s: financial breathing room. But even people who avoid emergencies can still fall into another massive trap, a trap that has quietly become one of the most expensive habits of modern life: And it starts with a simple piece of plastic.
Let's talk about the plastic trap, credit cards, and the invisible dangers lurking online. Debt isn't just a number on a statement. It's a slow-acting wealth killer. Many young adults in their 20s fall into the credit card trap because it feels like free money. You swipe now, pay later. No problem, right? Wrong. Credit cards are high-interest debt machines. And in today's world, with interest rates rising globally, carrying balances is more dangerous than ever. That 18% APR that seemed manageable last year, it compounds against you, quietly eating your money while you sleep. Financial experts consistently warn that high-interest debt is one of the fastest ways to destroy future wealth, even for people who earn a decent salary. But that's just the start. There's also the invisible threat of scams. Here's a shocking stat. $63 billion is lost annually to non-credit card fraud, and a disproportionate amount hits young, tech-savvy investors. Why? Because today's scams aren't just email spam. They're highly sophisticated, personalized, and often disguised as investment opportunities. Crypto schemes, fake trading platforms, phishing texts, and pump-and-dump stock tips flood social media. The worst part? Many young investors fall for them because they overestimate their knowledge. That same overconfidence trap we talked about earlier. They believe they can spot a scam or beat the system, and unfortunately, some of them learn the hard way that sophistication doesn't equal immunity. So what's the takeaway? Avoid high-interest debt at all costs. Pay off credit cards in full each month. Automate payments if necessary. Educate yourself on scams. Follow official resources, double-check sources, and never invest money you can't afford to lose. Check your risk tolerance. Just because an opportunity seems hot online doesn't mean it fits your financial plan. Debt and scams are sneaky. They often feel small at first, a few $100s here, a tempting hot tip there. But like termites quietly eating wood, they can dismantle your financial foundation before you even notice. And yet, even those who avoid debt traps sometimes fall for the biggest myth in personal finance, the retirement illusion. A mistake so dangerous that it can leave young adults shocked decades later when they realize they have less retirement savings than they thought. Now, let's tackle one of the most dangerous misconceptions young adults have about money, the retirement myth. You've probably heard it a million times. Don't worry about saving now. Social Security will take care of you. Here's the hard truth. It won't. Social Security is designed to supplement, not replace your retirement income. It was never meant to be the primary source of your financial security. And with rising life expectancies, changing demographics, and political uncertainty, relying solely on government programs is extremely risky. Studies from the OECD and the World Bank show that many young adults underestimate how much they'll need to save for retirement, sometimes by hundreds of thousands of dollars. Here's why it matters in your 20s. The earlier you start saving, the more time compound interest has to work its magic. This isn't theory, it's mathematics. A small contribution now, like $50 to $100 a week, can grow into a substantial nest egg by the time you retire. Waiting until your 30s or 40s to start saving means you'll have to contribute far more each month just to reach the same level of financial security. And that's assuming you even stick with it consistently, which most people don't. Let's be real. Retirement feels far away in your 20s. The future is abstract, but here's a simple mental trick. Treat your retirement fund like a time machine. The money you invest today is working for you decades in the future, long before you even think about needing it. Some practical tools for young adults include Roth IRAs. Post-tax contributions grow tax-free, perfect for long-term compounding. Employer 401k or equivalent.
Take advantage of any match. It's free money. 529 plans, not just for kids. You can invest in your own education or skills for future earning potential. Automatic contributions are crucial. Out of sight, out of mind. Let compounding do the heavy lifting while you focus on your career, learning, and life experiences. The biggest takeaway? Don't wait for someone else or a government program to secure your future. Your 20s are the launch pad for long-term financial independence. Every year you delay is a year lost, and lost years are exponentially harder to make up later. Avoiding the retirement myth isn't glamorous. There's no immediate reward. But combined with avoiding overconfidence, mastering the big three, protecting yourself from fragility, and steering clear of debt and scams, it becomes a cornerstone of lifelong wealth. And that brings us to the final piece of the puzzle, the mindset that turns all of these lessons into real, lasting financial success. So here's the bottom line. Avoiding these financial mistakes isn't about luck. It's about awareness, consistency, and mindset. Overconfidence, ignorance of the big three, delaying investing, financial fragility, high-interest debt, scams, and the retirement myth. These are all silent wealth killers that can quietly destroy your financial future if you're not careful. But here's the good news. Every single one of these mistakes is completely avoidable. You have an unfair advantage if you start now. Time, knowledge, and discipline compound just like money, and the earlier you start, the easier it gets. Think of your 20s as a training ground. The small habits you build now, like setting up automatic contributions to a Roth IRA, maintaining an emergency fund, learning to diversify investments, and continually educating yourself, will pay off exponentially in the decades to come. The secret? Stay a student of money. Read, learn, ask questions. Don't let ego get in the way. Surround yourself with mentors, follow credible sources, and test your knowledge regularly. Respect the power of compounding, not just for your money, but for your habits and mindset. Your 20s are your most powerful financial decade. Protect them. Invest in yourself. Avoid these silent wealth killers. And remember, financial freedom isn't about making a fortune overnight. It's about making smart decisions consistently, year after year, while giving time the chance to work its magic. Start small, start today, and watch how decades of smart, consistent choices can turn your 20s into a launch pad for a lifetime of wealth and freedom. The best part? You're not just investing in money, you're investing in your future self, someone who's prepared, resilient, and financially empowered. It all begins with awareness.